Stocks open firm but pull back even as the market breadth remains positive. Utilities, industrials and realty are the big gainers. Autos, financials and FMCG are the draggers.
Bharti Airtel reports a mostly in-line quarter, but subscriber addition surprised, while Shree Cement manages better than expected realization but guides for a more moderate 8 to 10% growth in FY25.
Siemens shares jump after it beats street estimates on almost all counts. The company also lines up for a capex of about 1,000 crores and says it will demerge its energy vertical into a separate listed entity.
Thermax and PB Fintech are among stocks that react positively to their inclusion in MSCI's Global Standard Index following the quarterly review, but most F&O stocks see muted moves due to prior positioning.
Metals shrug off the imposition of higher tariffs on Chinese imports. Copper holds near two-year highs on tight supply in the face of rising demand.
Hello and welcome to Halftime Report on CNBC-TV18. I'm Ekta Batra. With me is Mangalam Malu. Well, it is a bit of a down day for us. We have the mid-cap index, however, which is doing better at this point in time, so up around 0.8%. Well, nonetheless, we will be focusing a lot in terms of the US data, which comes out. So it is the US CPI data. We had the US PPI data, which was out yesterday, but now we have the US CPI data. All eyes will be on that on this Wednesday. It is estimated that it's probably going to come in at around 3.4% for the month of April, and that should probably see a little bit of a softness as compared to the month of March. So 0.3% on a month-on-month basis as compared to around 0.4% in the month of March. That's the month-on-month momentum. Let's see whether that comes through. The Fed meets on the 11th of June, so maybe that'll be a precursor to that. But nonetheless, for us, it's all about elections, what's happening with the India VIX, and earnings.
Absolutely. Hi, we'll watch out for all that. The market's in that band right now where, both upside and downside risks are limited, which explains why we're, moving around with high volatile environment, facing some, seeking some more clarity before it seeks a lot more direction on either side. But now as we speak, it's all about a lot of these individual stocks. The good part is more stocks are advancing than declining. And as we speak, at the bottom of your screen, some flashes coming in from the conference call of Colgate, which started at 10:30 this morning, just about ending. So the important highlights of the con call are: one, pricing growth will be lower in FY25. In the fourth quarter itself, price-led growth was around mid-single digits. That's what analysts are expecting. And instead, the growth will be led by volumes and premiumization in FY25. That's pretty positive in terms of the outlook coming in. But more importantly, the company said that they will focus on a couple of factors. One, margins may not see a bigger improvement from current levels, and that's not something that the street was expecting anyway, largely because, the company's reported a record high margin in the fourth quarter. The margins are closer to 35, 36%, and that's higher than any other FMCG company in the country right now. So the street would like the company to actually scale back a little on margins and go ahead and increase volumes and premiumization. That's exactly what the company has been doing. Apart from that, they will have an increased focus on personal care, the parent portfolio brands that they will bring into India, and Palmolive as well. They have had a slew of new launches in the Palmolive portfolio, and that's a portfolio that's growing twice as fast as the overall industry. So there has been some disappointment right now because the street is looking at no further improvement in margins as a negative. But my sense is that this should be considered positive, given that a lot of people quibble about, FMCG companies making a lot more margin and compromising top-line growth for that. If at 35% you don't see further upside, it's absolutely fine. Just scale back some of those margins, spend it back on advertising and prop up the top line, because that's perhaps the need of the hour.
Okay, all right. Yes, so we'll keep getting you details from the Colgate conference call highlights. As you can see, the stock is under pressure. As Mangalam mentioned, it was because of that margin guidance. But nonetheless, we'll get you more details as we get more details from the conference call itself. But as of now, let's focus on Man Infra. Sequentially, their bookings and collections have surged, but for the full year, both have declined. Margins also contracted on a year-on-year basis. The company's raised around 543 crores via a preferential issue. Manan Shah, who's the MD of Man Infra, now joins in to discuss more on their Q4 numbers. Manan, hi, welcome to the show. Well, overall, just wanted to start with your residential sales and collections, which are lower on a year-on-year basis. What explains this, and what is the targeted sales and collections for the entire fiscal that you ended the year with?
So basically, FY24 has been a year of acquisition for us. We had launched mainly two of our projects, which was Aradhya Avan, which is at Tardev, and Aradhya One Park in the last quarter of the last financial year. And the rest of the projects, realization had already gained momentum in the past quarters. That was the result. You saw a dip in the revenue. But if you see the overall contribution of the profitability, the profits have been shot up. We've crossed 300 crores of PAT this year, in fact. And what is the upcoming future looking like is we've acquired a lot of new projects which are going to be launched in the next coming quarters of next 3 to 4 months. So there are more than 4 projects which are due for launches, and that realization will soon start gaining in. And at the same time, if you see the business modality of our company has got mixed of redevelopment also, and we've taken a lot of DM partnership projects where the revenue does not come into our books, the straight profitability hits in. So that will also soon start getting realized because the project is just being launched, and few more DM projects are due in the pipeline in the next 6 months, which we would be launching.
All right, that's interesting because you did speak about Aradhya Avan and the project near Marine Lines. I'm looking at all your upcoming projects. That's Aradhya Avan, Aradhya One Park. There's a project at Goregaon West, the one near Marine Lines, the residential towers that you have. Together, they have a potential of roughly 10,000 crores going as per what you've told the exchanges. What is your launch pipeline apart from this looking like for FY25, and what's the potential revenue pipeline from all of this?
So next year, which is till March 2025, we anticipate to launch around 1 million square feet, which would contribute to around 4,000 crores of approximate sales potential. And on a year-on-year basis, the targeted pipeline should be nearly 1 million square feet of carpet area, which we are anticipating. And we've also even secured these kind of projects. So like the one which you're talking about, Marine Lines, the Marine Lines, we are done with the entire design phase. The approvals has been put up, and I think we are expecting in next 2 to 3 months time we should be ready to go and start the basic work at site. The sales will still take time because we would be launching it in a particular fashion. So I think Diwali would be the most feasible time, which is a year of launches for all the developers. So that's when we anticipate to launch that one. One Park is already launched. We've got great numbers on that project where 300 plus crores of sales has already happened as of March 24, and we've clocked a lot more post that as well.
Your One Park is located where? Just to get a sense.
It's at Ghatkopar East.
Okay, so when you're saying that the inventory sale has been good or the sales have been good for that particular project, I think 300 crores is what you mentioned. What is this total sales potential, and are you seeing any sort of movement in terms of prices when you are selling these projects?
So the total potential is approximately nearly 1,200 crores, where I think by next year we should be clocking more than 600 crores of the total sales. The momentum is very, very strong. And yes, the pricing, see, it depends on apartment to apartment. A lot of these larger apartments, which is currently the trend of the market, are selling at a much higher price compared to the smaller units. So it depends absolutely on each apartment, the pricing ranges.
No, on an average, has pricing risen?
The pricing for us, because it's a gated community project, we are gaining much better prices compared to the competition, which are standalone buildings. So yes, the pricing for us has gained.
Right. You did speak about the redevelopment potential here and speaking about around 4,000 crores of projects in redevelopment itself. The margins in redevelopment, are they better than regular? One presumes because a lot of the stuff is done already.
So in redevelopment, what basically happens is the capex drastically reduces, and any money which is being put into the project goes in starting of the project. Usually what happens is, in a typical case, when a developer starts buying the landowner takes the money completely out of the project. So you need furthermore capital to be infused to start the project, which is permissions, for sales, for marketing, for admin related costs, etc. For us, margins are definitely good. We work on a 25% approximate net margin basis, under which we do not intend to take main projects unless and until there's an absolute security on the location, which is the top of the line in Mumbai. But nearly we've been able to secure at least 25% margins in all of our projects. It may be from a redevelopment or certain places where we are even doing partnership models. There the margins are even further higher because all the cost has been borne by the landowner, and we share a revenue on the top line basis.
Okay. The US, you have a residential projects in Miami. Can you give us a sense in terms of how they are doing and what is the further plan for the US? Are you making money there? If so, what are your margins and profitability?
So US, we've currently secured 3 projects, out of which one project is already completed, which was a villa project. We had constructed 2 villas, out of which one is in fact already sold. The second is almost on the verge to get contracted over there. So this project, yes, the margins are really good. Like we are working on at least a 45% margin on that particular project. And the other 2 projects, we've just secured the land for that project. The due diligence is completed. Now the planning phase is going on. The launch should be anticipated to be start approximately in the month of March next year.
All right. And final question then, what's the current value of the unsold inventory that you're sitting on, and where have you deployed the money that you've raised recently, 543 crores?
So out of 543 crores, the money which has been coming to us is around 125 crores. The rest of the money is going to come in by July next year. That's the
Okay.
estimated timelines where they can convert this. And the money that we've infused is nearly around, say around 200 crores on a total project basis. Where certain money is still lying with us. We've kept the liquidity because, like I said, I've just acquired few more projects. The infusion is yet to happen in these, which will come in the next 6 to 8 months' time.
And the unsold inventory?
The unsold inventory for ready possession apartments is nearly negligible because, like our Ghatkopar project is 99% sold out. Our Aradhya High Park project, which is at Mira Road, Dahisar, that is 99% sold out. Ville Parle is 100% sold out. So we are sitting on negligible inventory as of today.
Wow. Okay, just talks about the demand in the Mumbai market, which is completely relentless as well. Thanks very much for joining in, Manan, and wish you luck for the projects ahead. So that's Man Infra. That stock is in focus. And in fact, talking about the real estate stocks, we have a lot of these real estate stocks buzzing today. Brigade Enterprises up 8.5%. Prestige Estates up around 3.8% at this point. So just watch out for that space. And separately, we had Apollo Tyres. The conference call is on, and those are some takeaways which were on your screen. They expect demand to pick up post the elections. We'll take a break. On the other side, Manisha Gupta will join in on our commodity segment. Stay tuned.
Welcome back, and joining us now on the show is Ajit Mishra. He's Senior VP Research at Religare Broking. Mr. Mishra, hi, thank you so much for joining us. And the focus on conversation is gold right now, because we've seen strong gains in the previous year, and this year as well we've seen a new all-time high, and we seem to be holding above $2,300 an ounce with whatever different fundamentals, events and data points that are coming in right now. What's your sense, first of all, on what you would watch in sense of global central banks, geopolitics, because these are a couple of factors which clearly have been supportive?
Yeah, good afternoon, Manisha. So yes, we have been seeing a steady run in gold for the last 3 years, including the current performance that we are seeing. And in the recent report, we have highlighted like 6 key factors which are basically favoring this up move to continue in the current calendar year as well. So first and foremost is the inflation, which is still sticky, and we have not seen any sign of slowing down in the US. Today we have the CPI data also scheduled. But at the same time, there are hopes that there could be one rate cut by the end of the year from the US Fed. So both these factors, like a sticky inflation, but at the same time, hopes of possible rate cut from the US Fed, is helping this gold to continue with their current momentum. At the same time, this geopolitical tension. So earlier it was Russia, Ukraine, and of late we started seeing that the Middle East tension. So that has also resulted in a sharp uptick in the demand for the safe haven that includes gold. And another important aspect that we have highlighted, that the demand from the central bank. This has something which we've been observing as a new trend emerging. Where China is leading from the front, especially in a scenario like this, wherein the global economic growth is also showing sign of slowdown. So, and lastly, that the investment demand is also helping this index, this metal to shine further. So all these factors put together are indicating that this prevailing momentum, which we are seeing for the last 3 years, continuing in 2024 as well.
Ajit, would you say that many of these factors are now baked into the prices? And from here on, what do you think that the gold prices will watch for? And is there any sense on where do you see the prices heading from here?
So yes, somehow yes, all these factors have already discounted, but at the same time, we are still seeing that issues are lingering, and we are still not sure when we are going to see that inflation coming down in the US and accordingly the reaction. But I feel that somehow it is already like they're okay with this kind of inflation, is what the recent statement from the US Fed chair indicates. So I feel that despite all the known factors, this momentum is here to stay, considering that this lingering tension, especially in the Middle East, that might continue to help this, and plus the global demand, especially from the China central bank, that will help this metal to continue to shine. Now coming to the short to medium term targets, we are eyeing 74,000 as an immediate target, and eventually around 78,000 in next 3 to 6 months. And we feel that instead of accumulating or buying at the current levels, one should gradually accumulate gold, especially after the recent run up. So until unless we break 65,000 mark, we feel that this tone is likely to remain on the positive side. And if we break 65,000, then the scenario might change. So as of now, it's something that one should look for accumulation on every dip, with 74,000, 78,000 being the probable targets.
Ajit, also when you look at the buying patterns within India, how are you looking at that? Because while of course we've seen jewelry buying, which continues to be a big chunk of Indian buying, but would you say that the ETFs, the investment buying also seems to be doing well now?
Yes, so in fact, when it comes to the global investment demand, the OTC demand is slightly on the higher side. The other demand, basically for the ETF and physical demand, they are also seeing a kind of a uptick, but not in comparison to what we are seeing in the OTC market. But domestically, yes, since during the festive season, we usually see the uptick in the demand, and that might continue in the probable future as well.
How are you looking at Indian financialization in sense of gold continue from here on? I mean, do you see more products come in? Because even now, as we continue to talk that, as you said, OTC market, the physical market is more stronger. And when you look at gold as a part of portfolio for many of those as a financial product is still under-owned.
That is correct. So in fact, that we have the perception that, one should have only gold when they are risk averse or something like that. But I feel this is the best instrument if somebody is planning to diversify their risk, and especially in a market like this where we are seeing the equity markets also doing well. So we usually recommend to our clients, so at least based on their risk appetite, 10 to 20% should be gold in their portfolio to diversify that. And now people have started accepting this, be it through souvenir gold bond or through ETFs, they started investing. So obviously, we'll see this trend, strengthening further in years to come.
Okay. Okay, all right, Manisha. Thanks very much for taking us through the commodities segment and precious metals in focus. We need to take a short break, but up next, we'll talk technicals. Pritesh Mehta of Yes Securities will join us. Stay tuned.
Welcome back. It's absolutely flat for the market right now as we speak. Mild cut from the previous close levels is what we're seeing on the Nifty. But it's also a bit of a tug of war between both bulls and bears. As you would see, every time there was a dip, it had been bought into. But every time subsequently there was a rally, that rally has been sold into, with the Nifty meandering around the unchanged line. What's doing well is the mid-cap end of things, which is up around 1% for that index. Broader markets doing a lot better as well. So let's talk about this, congestion that the Nifty is facing at levels closer to that 22,300 mark. On May 9th, the high on the Nifty was 22,308. May 14th, which is yesterday, the high on the Nifty, 22,270 before it sold off. And today is 22,297. What's interesting about today's high is that it coincides perfectly with the 50-day moving average of the Nifty, which is 22,297. And there is congestion between 22,297 to 22,350. I mean, if you would broaden out that range, and that's largely because both the 20 and the 50-day moving averages are placed right there. But Could there be a case for an up move in the second half of today's trading session? There are two factors that point towards it. The first one, the India VIX, that's been cooling off. It was negative yesterday. Today as well went all the way up to 20.6, 20.7. From there, it's down to around 20.37. Secondly, we are seeing the advance decline ratio stay firmly in favor of the advances, even as the broader markets are doing extremely well. For the Nifty, 22,200 put has seen a fair amount of writing, telling you that 22,100 will be an important support to watch out for. But on the way up, the 22,300 call has seen an equal amount of writing, telling you that maybe around the 22,350 mark could be a bit of resistance, as we were pointing out, between the 20 and the 50-day moving average as well. In the second half, if the market has to recover, it has to be through the Nifty Bank, which has seen a fair amount of writing at the 47,500 put. But importantly, it's also seen writing at the 48,000 call for the Nifty Bank to cross the 50-day moving average of 47,667, just below which it stands right now, will be extremely crucial. The one stock I'm watching out for, Ekta, is Biocon. You track the company, but from an F&O standpoint, there's a high open interest build up. The stock's doing well. The open interest is now near 99% of the market-wide position limit, telling you that the stock may enter F&O band. So, irrespective of what the price tells you, the F&O space is telling you that something's, going to take place in Biocon, given the sort of open interest build-up that we've seen.
Okay, interesting. Well, the numbers are today, and they do release their numbers post-market, so I think the street will be watching out for that quite closely, and they do generally hold their call in the morning of which would be the next day. Now, we do have Pritesh Mehta, Senior VP Research, Yes Securities, joining in to discuss the technicals of the market. Pritesh, since we mentioned Biocon, wanted your view on Biocon and your overall take in terms of the markets and stocks.
Yeah, good afternoon. It's been tricky to take a call on a stock which is going to announce the earnings. But despite that, we can take a look at the structured view of the stock. So Biocon, in fact, entire pharma space is looking interesting. If you look at the ratio, pharma versus Nifty, it is outperforming. Within that basket of pharma stocks, something like Aurobindo, Lupin, and even Biocon, they look interesting. In fact, when I look at the structure of Biocon, it is providing a follow through after bullish anchor column. It tells us there could be a continuation towards 365 levels in this particular stock, at least for near term.
All right, and individual stocks, what are you thinking of?
So when we talk about, right now, see, we had seen a period of correction in market. And now when we look at the breadth of Nifty Bank, of the broader markets, they are reversing of bottom. It tells me it's not the right time to create shorts. In fact, we need to look for buying opportunities. So something like SAIL looks very interesting. SAIL of the metal pack, it's showing outperformance. Above 168, we can see levels of 184, 187 in next couple of days. And the stop loss would be around 159. Second stock which we like from the broader markets is Coromandel Fertilizer. Coromandel International. This particular stock has provided a breakthrough from bullish shutter pattern, and I'm expecting a run up of at least 15% from here on.
Are you looking at Interglobe Aviation, Pritesh? I mean, that stock's been on a one-way rally. In fact, this year itself, it's seen a jump of 40%. The last 12 months, it's doubled. It's taken off and is in literally cruise control.
See, in fact, this kind of stock, we need to keep under radar. And any sort of dip would provide a buying opportunity. It is outperforming enough in a scenario where market is taking time, market is consuming time. Where broader markets, after a couple of days of rally, they tend to be, flat. So this stock needs to be kept under radar. If we get this stock around 4,000 levels again, I think we can see a rally towards 4700, 4800 also.
Okay, all right. We're going to leave it on that note. Thanks very much for joining in, Pritesh, and giving us those updates. We need to take a short break, but we'll get you more on the markets. Lots more opinion on the other side. Stay tuned for that. Welcome back. Well, definitely a lively market when it comes to the broader markets. Just want to point out that Indegene is doing well today. It's had a little bit of a rocky start. It did go up on the day of listing. After that, there was a decline. So today it is gaining up around 2.5% for Indegene in today's trading session. Net is done well post-listing. And we do have a couple of other stocks which are managing to see some amount of upside. So IFL Securities, that would be one stock which has gained 10% this week already and up 6.5% at this point. Zomato too seeing a comeback today, so that stock is up 2.5%. But Radico Khaitan is in focus post its Q4 numbers. Manglam, you've been doing the math on that one. Tell us more.
Well, it's basically a descriptor of what consumption in India is like. It's the premium products which are doing extremely well. And in that, Radico Khaitan's ultra-luxurious products, which are basically, the craft gins that they make, along with the single malts that they make from India itself, are doing extremely well. So if you just take a look at the reported numbers, there has been a near 29% jump in their revenue, almost a 30% jump. And that's actually resulted in a near 55% jump in their EBITDA. That means the margins have improved from 9.5% to around 11.4% as well. And that's resulted in a 27-28% jump in their profit after tax as well. On an overall volume basis, the popular volumes are not doing too well, which are the lower priced products, and which is why the overall volumes have actually declined by 1.2%. But if you look at the prestige and above volumes, that's seen a growth of around 14.2%, and that's actually led by 16% revenue growth in the prestige and above business as well, which now accounts for nearly a third of their overall revenues at around 503 crores for the fourth quarter. The company has given us an inkling into what FY25 is likely to look like as well. They've said that they will deliver double-digit premium volume growth in FY25, and that's not all. While, the costs of some of their key inputs, which include grain-based alcohol or ENA, even glass bottles, continue to remain volatile, they will see some bit of margin expansion alongside reinvestment in A&P spends for, the company, for branding, etc., would be close to 6 to 8% of their IMFL revenue. So Radico Khaitan, basically the stock doing well because some of their premium products are doing extremely well, and that's reflecting in their margins, though it's mildly off highs. Maybe this quarter will be a bit of a blip, largely because of the elections related issues. And obviously, during a long election, a 7-phase long election, you'll obviously have more dry days in more parts of the country than there were earlier. So barring the first quarter, the remainder of the year looks good for the company.
Okay, all right. So that's on Radico Khaitan. Siemens is also in focus after reporting a good set of its numbers for September year ending 24. Vamakshi now joins in with the details on this. Vamakshi.
Well, absolutely. A good set of numbers coming in from the company, a beat across the board. When we look at the revenues, they've come in at 5,749.9 crores versus our poll of 5,544 crores. This is 4% above what we were expecting, and this growth is largely being led by the smart infra, digital industries, as well as mobility businesses. But even the energy business is seeing an uptick of almost 5%. The margins have improved for all segments, and resultantly we have an EBITDA margin of 15.3% as compared to what we were expecting of almost 12.6%. The net profit also has come in almost 41% higher than what we were expecting, and this is largely being driven by volume as well as price effects, as well as continued productivity measures that the company has undertaken. When we look at the capex that the company has said, they have announced that they will be undertaking total capex of over 1,000 crores in the medium term, out of which they've already announced some bit of capex back in November 2023, but they will be undertaking additional capex of 333 crores for smart infra and a switchgear expansion in Goa, and 186 crores for setting up train manufacturing facility in Aurangabad. They've also announced a demerger of their energy business, and it will be demerged into a separately listed entity, namely Siemens Energy India, and this will take place by calendar year 2025. But the disappointment this time around was in terms of the order inflow. They stood at 5,184 crores. This is a downtick of almost 9%, excluding the large locomotive order that the company received in the same quarter last year. This slowdown is largely mainly on account of the deferment of some large orders. There has also been a slowdown in ordering of industrial automation products due to channel destocking. Overall, we have a note coming in from Jefferies as well. They believe that the company will benefit from sizable power transmission capex ordering. They've gone ahead and revised their EPS estimates by around 2 to 19% for FY25 and 26 and gone ahead and raised their target price to 8,000 rupees per share. So overall, a good set of numbers. Some announcements coming in terms of capex as well as the demerger boding well for Siemens.
In terms of ordering, so there are two parts. One is the normal projects and standard business is doing well overall. We are growing overall. Our first half year has been good. If I look at the first half year, we expect to continue to grow healthily for the second half year. The challenge that we have is only the slowdown in one part of our business, which is in the industrial automation part of our business, which is where we expect that there will be a normalization in the demand starting in the October-December quarter. Volumes have gone up, and with the volumes going up, there is definitely an impact, a volume impact appearing in the margins there. In addition to that, there have been cost control measures that the company has gone into, carried out, as also other productivity measures in our factories and other areas. In addition, we've had some special earnings because of sale of some property and some dividend that we received. So overall, our intent is to continue to grow the margins as we increase our digital component in the business. There will be an increase in margins as we increase the digitalization initiatives that we have launched here in the company.
Welcome back. Well, that's about Siemens. Just keep an eye on a couple of stocks, three stocks in particular. One is D-Link. We've spoken about, the price volume sort of breakout that has taken place in D-Link India in yesterday's trading session. And today follows up with another big volume-led up move that we're seeing on the price. The stock is up 11% and has moved to the high point of trade. It's actually seen volumes already nearly 3.5 times what it sees on a 10-day average. Yesterday, this number was close to around 11 times. So a big move on D-Link India. So this is something that we'll keep an eye out on. The other one is Paradeep Phosphates. Just look at that one. Reported its numbers just about 20 minutes ago. The stock has rallied about 6% from the lows. The profitability has doubled year on year at 19 crore versus 9 crore. Of course, there's a big decline sequentially. So Paradeep Phosphates is the intraday chart that should come up for you. A big spike is what you will see mostly in the last 20 minutes post the company's numbers being reported. And the third one I'm looking at is Zomato. Now, Zomato had seen some profit booking over the last two trading sessions post its numbers. Brokerages saying that maybe the easy money in the stock has been made, but there was no taking away from the fact that the numbers were good, and now the stock is back to its winning ways at the high point of trade. Let's move on to some primary market action now. We'll talk about the 2,600 crore IPO of Digit that is open in for subscription. Yash joins in with the details on this new debutant. Yash.
Well, Mangalam, after New India Assurance and ICICI Lombard, Digit is gearing up to list itself on the stock exchanges, becoming the third general insurance company to do so. The IPO opens today, closes on May 18. The price band is between 258 to 272 rupees per share. A fresh issue size of 1,125 crore rupees, offer for sale of about 5.5 crore shares amounting to 1,490 crore rupees, total issue size of 2615 crore rupees. As far as the selling shareholder is concerned, 99.98% of the total OFS issue comes from the promoter, that is Digit Infoworks. As far as the objects is concerned, the entire amount of about 1,125 crore rupees raised through the primary issuance will be used towards enhancing the solvency at Digit General Insurance. If you look at the financials for the company, as per 9 months FY24, the gross written premium was up 26%, net earned premium up 36%. Operating losses, importantly, they came down by 82% at an operating loss of 10 crore rupees. Net profit came in at 129 crore rupees versus 10 crore rupees. Combined ratio, importantly, was at 108.7 versus 109.1. Number of customers added went up by 22%. Policy issues went up by 10%. Now, just to give you a sense in terms of how small the company is as compared to the two other listed players, ICICI Lombard and New India Assurance, the total income of ICICI Lombard is 2.5 times. New India Assurance is 5 times bigger than Digit. ICICI Lombard issued 3 times. New India Assurance issued 3.5 times more policies than Go Digit. ICICI Lombard's gross weighted premium is up 3 times. New India Assurance is up 5 times more than Go Digit. ICICI Lombard's net earned premium, that is more than 2 times, and New India Assurance is more than 5 times as compared to Go Digit. Now, 2 important parameters. One is operating profit. Go Digit's operating loss was at 10 crore rupees. ICICI Lombard has an operating profit of about 1,344 crore rupees. And the second important parameter to look at is combined ratio. Go Digit's combined ratio, as I said, is 108.7. ICICI Lombard is at 103.7. Despite these two being in favor of ICICI Lombard and the size being in favor of ICICI Lombard, Go Digit is coming at a valuation of 9.7 times price to book value. Compare that to something like ICICI Lombard, which trades at 7.95 times price to book value. New India Assurance is even lower at just about 1.5 times price to book value. Now, in terms of risks, there are 5 key risks that I pointed out. One is that the underwriting losses for the company may continue because investments in distribution and infrastructure, digital infrastructure, may remain elevated. Second one, dependence on motor portfolio. 61% of the premium comes from motor. Any problems in that particular segment could create problems at an aggregate level. Expenses of management guidelines from the regulator could constrain spending from the company, and dependence on brokers also could become a problem for the company. The fifth one, geographical concentration. 55% of the revenue comes from Maharashtra, Karnataka and Delhi. Any catastrophic incident in these states could create a problem for the underwriting performance as far as the company is concerned.
Okay, all right, Yash, thanks very much for that. We'll take a short break, but we'll get you more on the markets. Stocks continue to be in focus, so we'll get you a lot more news. Stay tuned.
Welcome back. You're watching us here on Halftime Report. Market doing market things. Absolutely flat for the frontline index. The mid-cap index doing well. So a good time to get in some words from the wise. In an exclusive CNBC-TV18 conversation, Parikshit Luthra, our colleague, is speaking with Mark Mobius, Chairman, Mobius Emerging Opportunities Fund, of course, the big bull on India and the wise man of Wall Street, along with the Indian stock markets as well, investing.
They had humble backgrounds, or maybe worked as a carpenter for that matter, but through wise investments, through patience, through frugality, they managed to earn a fortune over a 20 to 30-year period. So what does this really mean, and what's the lesson in all of this for people getting into the stock market right now?
A very important point. You know, a lot of people think that, oh, I've got to have a college degree. I've got to go to a university, or I've got to finish high school. All these things are not necessary if you are willing to learn. You know, the books are available in the library. You can go to any library. Most countries in the world have libraries. And now with the internet, it opens the whole world of education to anyone who's willing to buy a cell phone or a small computer. So the education aspect is something that's very critical, and you must not think that it necessarily means a degree. A degree is just a piece of paper. It's what you have in your brain, what you've learned, and what you've practiced is the most important. I would say 50% or 60% of the people who have degrees normally don't go into the field in which they were educated. They go into something different. They could have done that without having the degree. So this is very important. Don't forget about the degrees and the paperwork. Think about what you're actually learning and how you're applying that learning to your life.
Right. You've also spoken and quoted someone to say that it's your attitude, not your aptitude, which decides your altitude. Is that very important in the current context?
Exactly. You see many, many people around the world that have a great education, formal education, have a great aptitude for a certain field, but they don't use it. They don't apply it. And therefore, they're not going to be successful. They don't have the right attitude. In other words, they don't have the attitude to be successful, the attitude to learn more, to keep an open mind, and to progress, to move forward. So that's why I say attitude is more important than aptitude.
Right. Now, speaking about the emotion portion, you've warned investors to avoid the emotion portion in the markets. Avoid a herd mentality. Stay calm. Be knowledgeable. Study the markets well. Study the stock well. And then decide your call. What would be your advice and context in the current environment in India and globally?
Well, in the book, I mentioned the term emotion is the potion. In other words, the markets are driven more by emotion than by intellect or by rationality. In fact, that's the case of our lives. If you look at your normal daily life, you find that so much of it is driven by emotion. When it comes to investing, you've got to be much more rational. You've got to observe emotion. In other words, understand emotion, understand the crowd behavior, and use that understanding to invest. But don't get involved yourself in the emotion of the market. And I remember John Templeton saying the best way to invest is to buy when others are selling, are despondently selling, emotionally selling, and to buy when others are aggressively selling, and to sell when others are aggressively buying. So this is the kind of thing that you've got to recognize when you're looking at a market.
Right. Mark, coming back to the India scenario, there are, of course, a lot of things which affect the sentiment in the markets. And currently, there is a certain degree of volatility, a decline in the Sensex and Nifty that we've seen because of Indian elections. That is what several experts suggest. Do you think this volatility is indeed due to elections, or are there other factors at play? How should investors see this?
I think there's no question the elections are having an impact because people do look at the elections very carefully. Everyone is involved emotionally in one degree or another, and they tend to react emotionally in the market itself. So now there's an opportunity, because if you can look at the emotion in the market and recognize that perhaps the emotion, the direction of the market driven by emotion is wrong, then you should do the opposite thing. In other words, if everyone's selling, maybe you should be buying, and vice versa. Of course, based on the fundamentals, on the actual fundamentals of the companies in which you are investing. So yes, I would say that for India now, probably the Indian elections are having a big impact on the emotion of the market.
Right. We've seen at least 47,000 crores offloaded by foreign institutional investors since the time the elections began in India in April. Approximately $6 billion have been offloaded, Mark. What, according to you, would be the reasons for this?
It's probably because the uncertainty arising from the election. A lot of investors, not only foreign investors, but investors anywhere in the world, including Indian investors, tend to hate uncertainty. They don't want it to be uncertain. And of course, as you mentioned, the outcome of the election is uncertain. Some people say that Modi will get a supermajority and that he'll be able to get more seats in Congress. Other people say no, he may not, and that creates uncertainty. So whenever there's uncertainty, people say, okay, I'm out of here. I'm going to wait until I find out what's really going to happen, and then I'll invest. So uncertainty is a big, big driver to this, and that's probably what's happening with foreign investors.
Right. Let me ask you about 2 to 3 scenarios. One is if the Prime Minister, the BJP, the NDA, they cross the 400 seats mark, as they have been suggesting and claiming that they will win big, they will win with record numbers. If they manage to do that, how do you see the markets reacting, and what will be the growth momentum and investment momentum and attitude towards India?
I think if they do that, the market will probably do well, probably move up, barring any other factor coming in. But I would say it would be good news for the market. And more importantly, it will be good for the economy, because then the policy objectives of growth and the adoption of technology will be very important. One of the key aspects now for India will be its ability to attract foreign technological investments, semiconductors, software, etc. There's an incredible opportunity for India to become the center for technical innovation and technical manufacturing. And that will depend on the degree to which the Indian government is able to attract these large manufacturers from China, from Taiwan, from US, Japan, etc. And that, of course, depends on the degree of bureaucracy and restrictions that the Indian government imposes. And my reading is that the Modi government will probably try to make it more attractive and loosen up these restrictions, which will attract more foreign investors.